Welcome to The Explainer. Today, we are going to break down the one thing that truly separates successful investors from, well, everyone else. And here's a hint for you. It's got nothing to do with predicting the future. It's all about what's going on up here, in your head.
So, what really separates the winners from the losers? I mean, is it some genius stock-picking trick? A secret algorithm? Maybe? Or is it something way deeper? Something psychological? Yeah, that's what we're going to dig into.
All right, let's start by looking at path one. This is the pessimist's trap. And believe me, it's a path a ton of people find themselves on, sometimes without even knowing it. You know, this whole thing boils down to a powerful psychological quirk called loss aversion. It was actually figured out by Nobel laureate Richard Thaler. And what he found is just fascinating. The pain of losing money feels about twice as intense as the pleasure you get from an equal gain. Think about that. That wiring in our brains makes pessimistic investors just fixate on bad news. They're constantly checking their portfolio, basically just waiting for the sky to fall.
And you can guess what happens next, right? It leads to this absolutely disastrous cycle. The market takes a totally normal dip, but their fear just takes over completely. They panic, they sell at the exact worst time, locking in all those losses. And then, they're just paralyzed by that fear. They sit in cash, miss the entire market recovery, and get hit with what's called cash drag, where inflation just slowly but surely eats away at their savings. It is, no joke, a guaranteed way to destroy your wealth.
Okay, so that's the pessimist. Now let's swing to the complete opposite end of the spectrum, which, believe it or not, is just as dangerous. This is path two, the optimist fall.
So this type of investor, they're running on pure overconfidence. They genuinely believe they're smarter than the market, that they can time it perfectly. And this leads to something called action bias. It's this irresistible urge to always be doing something, always trading. But you know, there's a famous study that put it perfectly. All that frequent trading, it's literally hazardous to your wealth.
So what's the result of all this? Well, they're constantly jumping in and out of stocks, chasing the next big thing. And what does that usually mean? It means they buy right at the peak of the hype. All that frenetic activity just racks up huge transaction fees and taxes that absolutely eat into their returns. And the punchline? They almost always end up doing worse than a simple, boring market index fund.
So there you have it. Two paths, both leading straight to disappointment. You've got the pessimist, who's so paralyzed by fear they sell at the very bottom, and then you've got the blind optimist, driven by pure arrogance, who buys at the very top. I mean, they're polar opposites in their mindset, but they end up in the exact same place. Losing.
Okay, so if fear is a losing strategy and arrogance is a losing strategy, what's left? What's the third path? You know, the one that actually works, the one that builds real wealth over the long haul.
The answer is something called cautious optimism. Now, I know it sounds like a contradiction, right? But it's this incredibly powerful blend of two ideas that seem like they shouldn't go together, but when they do, man, they are the perfect recipe for success.
So let's really break this down. The optimism part, that's what gives you the courage to put your money to work in the first place. It's the belief in long-term human progress, in the magic of compound growth. But then you have the cautious part. That's your discipline. That's what tells you to manage risk because you know for a fact that downturns are going to happen. It's what makes you prepare for them, you know, with things like diversification. All right, so let's get into the why. Why is this balanced mindset so darn effective? What's the actual engine that powers this whole idea of optimism?
You've probably heard this famous quote from Warren Buffett, but when he says that, he's not just, being patriotic. He's making a much deeper point. What he's really saying is, don't ever bet against the long-term arc of human ingenuity and our ability to solve problems.
And if you zoom out, this perspective really makes sense. I mean, look at human history. Despite all the wars, the pandemics, the financial crises, the overall story is one of absolutely exponential growth. And what fuels that? It's the constant exchange of ideas. It's innovation in everything from AI to medicine to energy. So the cautious optimist gets it. They understand that a market crash, while scary, is really just a temporary blip in a much, much longer upward trend.
And this brings us to a really crucial point. When you invest in a broad market index fund, you're not just betting on Apple or Google or any single company. No, you are making a direct investment in that entire engine of human progress we've been talking about. You're literally buying a small piece of our collective ability to innovate, solve problems, and create a better future.
And that's where the balance becomes so important. That optimism is about having faith in that engine of progress. But the caution is about being a realist. It's about respecting the fact that there are real-world limits. Things like resources aren't infinite, and inflation is a very real risk that can eat up your returns if you're not careful.
Okay, so this all sounds great in theory, right? But how do we actually put this into practice? How do we get in the driver's seat? Well, let's use a really simple analogy to make it crystal clear.
I want you to think of your portfolio like a car. Your optimism, that's the gas pedal. It's the belief in growth that gets you moving forward down the road to your financial goals. But your caution, that's your brakes and your airbags. That's your risk management, your diversification, and asset allocation. And think about it, a car with only a gas pedal is a death trap. But a car with only brakes, it's never even going to leave the driveway. You absolutely need both to get where you're going safely.
And this is what that car actually looks like in a real portfolio. The engine, the gas pedal, that's your core holding of broad market index ETFs. But then you've got your safety features, your brakes and airbags. That could be a small allocation to a physical asset like gold for some risk management. And it's definitely a healthy cash reserve for emergencies or opportunities. The strategy couldn't be simpler, really. You hold for the long haul and you stay diversified.
And that right there is the real takeaway. At the end of the day, successful investing isn't about having a crystal ball. It's not about predicting what the market's going to do next week. It is a behavioral skill. It's all about mastering your own psychology, finding that perfect blend of optimism to keep you moving forward and caution to keep you safe, so you can stay on the road for the long term, avoid the ditches on either side, and actually reach your destination.